Introduction. Understanding inflation and its effects. Inflation is the rate at which the general level of prices for goods and services rises, leading to a decrease in the purchasing power of money. It is a critical economic concept that impacts everyone, from consumers to investors. Understanding inflation is essential for making informed financial decisions and protecting your savings. The mechanics of inflation and its causes. Inflation occurs when demand for goods and services exceeds supply, leading to price increases. It can be driven by various factors, including increased production costs, higher consumer demand, and government policies. Additionally, external factors like global supply chain disruptions and geopolitical tensions can contribute to inflationary pressures. Measuring inflation, Consumer Price Index and other indicators. The most common way to measure inflation is through the Consumer Price Index, CPI, which tracks the average change in prices of a basket of goods and services over time. Other indicators, such as the Producer Price Index, PPI, and the core inflation rate, help provide a broader understanding of inflation trends and their impact on the economy. The impact of inflation on purchasing power. As inflation rises, the purchasing power of money declines, meaning you can buy fewer goods and services with the same amount of money. This erosion of value can significantly affect consumers' ability to maintain their standard of living, particularly if wages do not keep pace with rising prices. Inflation and savings, the hidden cost of holding cash. When inflation outpaces interest rates on savings accounts, the real value of your savings diminishes over time. This hidden cost of holding cash can erode your financial security. To protect your savings from inflation, consider investing in assets that historically outpace inflation, such as stocks or real estate. The effect of inflation on investments and asset values. Inflation can influence investment returns and asset values. While some assets, like commodities and real estate, may appreciate during inflationary periods, others, like fixed income investments, may suffer. Investors should consider their portfolios and adjust asset allocations to mitigate the impact of inflation on long-term returns. Inflation expectations and consumer behavior. Inflation expectations play a crucial role in consumer behavior and spending decisions. When people anticipate rising prices, they may accelerate purchases, leading to increased demand and further inflation. This cycle can create a self-fulfilling prophecy, causing inflation rates to rise even higher. Strategies for protecting against inflation. To protect against inflation, individuals can adopt several strategies, including diversifying investments, exploring inflation-protected securities, and considering assets that traditionally perform well during inflationary periods. Staying informed about economic trends and adjusting financial plans accordingly can also help mitigate the effects of inflation. Conclusion: the ongoing challenge of inflation. In conclusion, inflation is a fundamental economic phenomenon that affects everyone's purchasing power. By understanding its mechanics and implications, individuals can make informed financial decisions to protect their savings and investments. Being proactive in managing the impact of inflation is essential for maintaining financial stability in an ever-changing economic landscape.